Vinay Jaising is Managing Director, Portfolio Management Services at JM Financial. He's now joining us. Vinay, hi, good afternoon. Thanks for joining us. We've seen a massive outperformance of Indian market compared to global market, and within that, the broader market is almost running on steroids now of late. Are you a bit nervous about the market, or do you think that's par for the course? Are you staying fully invested? Your view?
So very clearly, we believe that the market has certainly run up. If you see the last month itself, the market is flat to, if I add today's performance, up by 1% and the global markets are down 5%. If I look at it over the last year, the absolute market is still the same, which is up 1%, but you have Nasdaq, which is down 25%. The overall global MSCI market down, the world index down by about 15 to 18%. So the relative outperformance has certainly been a lot. Having said that, in the medium term, we remain constructive the Indian market because we think the earnings growth trajectory is very positive. But in the short term, due to a couple of reasons, which include valuation and liquidity, we stay a little cautious. We have between 8 and 10% of cash on hand as we talk.
Okay, 8 to 10% of cash on hand. Vinay, good afternoon. So as and when you decide to deploy that cash, where do you see the pockets of growth or value now? What are the areas of outperformance that you're looking at?
So we believe in a lot in two big themes. The first theme is the India resurgence theme, as we can see in the credit data of the country, which has gone from 5% 2 years ago to almost 15% currently. So we are very constructive, the private banks. So that's one space. The second theme we believe in is the Make in India or the manufacturing story. In the manufacturing space, when we talk about it, don't think conventional, start thinking about contract manufacturing companies, start thinking about those pharmaceuticals or specialty chemical companies, which are already outsourcing a lot from the country and selling it to the rest of the world. So these are the two big themes we are looking at invested, and we are already invested in them as well.
So when you talk about constructive on private banks, is it only restricted to banks? Because some of these NBFCs, especially the consumer-facing ones, have done exceptionally well, right? Bajaj Twins have come back in a big way, although still not at their all-time highs. What do you do here?
So between banks and NBFCs, we are clearly more constructive. The banks, for a couple of reasons, you're getting to play the entire banking cycle, be it retail or consumer. In the NBFC space, if you look at 2023 over 2022, one thing which will probably miss the mark would be the IPO financing, which they won't have. The second thing that will probably miss them would be the amount of IPOs coming into the market as compared to the previous year. So net of that, as far as the entire banking sector is concerned, you don't have those concerns. Having said that, even the NBFCs are currently taking loan from the banks. So you got another engine which is, singing as far as credit growth for the private banks are concerned. So you would lay eggs on that part of the basket.
Okay, fair point. Now, what about the auto sector? We've seen a huge run. I think 6 months back, when it was in a multi-year bear market, maybe the trigger was the decline in commodity prices. But the last 6 months, we've seen a phenomenal run in auto names. Your views?
So absolutely. I would go back to the previous comment you made about, you canceling your hotel stay. Just think about, how many people have been waiting to get vehicles coming in. And, the wait list is still at least a quarter plus. So I think the auto sector has gained on two counts. The first count is the demand has been fantastic based on the capacity available. Depending on the company we are talking about, you've got an average 1 quarter of inventory of demand lying with them and virtually no inventory. And the second is the raw material, because of commodities have come down. So there's no need of having discounts being given to the system. So you add the two and you see a medium-term outperformance on earnings trajectory as compared to the rest of the space. I think banks and the auto sector, you'll see some earnings uptick, but the rest of the sector with inflation numbers coming down, you will just see the earnings coming down as well. So we would remain constructive about the auto space as well. We are overweight out there. Having said that, valuations are starting getting a little unattractive in the auto space as well.
Okay, valuations are getting unattractive in the auto space. Any other sectors where you feel that the valuations are still good to go and growth is coming back in a big way? So, for example, some of these smaller themes, right? There's consumer durables that are coming back. There's defense that's picking up in a big way as well. Anything that you like there?
So, we, on the consumer theme, again, we were a lot more overweight. We currently are a lot more overweight, courtesy, not just that, but, absolute consumption, be it food, be it, drinks, be it the party mode or the wedding mode, which is coming up. So the consumption space is the third space we are overweight on. All this comes at a price. So where we are underweight actually are places like the IT sector and a little bit in the energy space. I'm going back to our first theme I mentioned, the India resilient story. The resurgence is very, very strong. You're seeing growth come in the banks and retail. It's coming from either direct consumption. So I would agree with that comment of yours. Or in terms of, if you look at the way the credit cards growth is happening by 15 to 20% or annual basis, it's just fantastic. So the demand from the Indian consumer is certainly up, and we are constructive out here.
Okay. Vinay, one space which has not done well is healthcare. It didn't do well when the market was down, and now it's not doing well when the market's doing well. What to your mind is sort of hurting this sector, and what's your view?
So, when we say healthcare, I'll add agro to healthcare as well. And you've got to look at them as individual companies on their own right. Some stocks have done fantastically, but because the large caps are largely domained about US sales and a little bit lesser about Indian domestic sales, you've seen the pain in the healthcare sector. Having said that, we are overweight the healthcare and agro space. But here, as I said, we would not be looking at purely the big ones. The mid cap and the small cap space in this sector, especially the contract manufacturing space or the specialty chemical space, I'm just adding all three of them together, is where we think, there's a lot of goodness happening because people are looking globally at a make in India story, and a lot of, products are being sourced out of India. So we would be, overweight in this space.
Okay. I know you spoke about how autos are looking a bit expensive to you, especially the OEMs, but we're having a big move in the auto ancillary names. Some of these non-index large caps, so to speak. Tube Investments, for example, is sitting at a fresh high. There's a big comeback in some of these battery makers as well, Exide, Amara Raja. And then, a lot of these companies, say something like a Jamna Auto, which have been good wealth creators in the past. Anything that you like from this space, the auto ancillaries?
So can't comment on stocks, but if the auto sector as a whole has demand which is going up, if you look at the amount of petrol and diesel consumption going up, the ancillary space in terms of volume demand has to be relatively good. So that's where I would like to comment on. As a sector, auto and auto ancillary is seeing the best ever demand in a couple of years, and that probably telling in the valuations and the demand of the stocks as well.
What about IT? Because that is where the big debate is on right now.
Sure. So, if I look at global macro situation, the 2-year, 10-year chart globally or in the US is virtually at a 20-year low. It was negative 40 bips a couple of days ago. It's negative 20 bips now. So what that is telling you is that the US economy, as you've seen in the last 2 quarters, has declined. In such kind of an environment, stocks which are directly linked to the US order book or the US GDP, IT comes a lot into that way. Again, I mentioned the pharmaceutical part, telling you to break it up into two. So one part, or the large caps there, are also linked to US. So, here we would be non-constructive as far as IT is concerned, and we are underweight out here. That doesn't mean, we are zero weightage. We are underweight by 300 to 400 basis points. We like the big names, however.
All right. We'll leave it there today, Vinay. Thanks a lot for joining us. It was good talking to you, and hope to talk to you again soon. We need to take a break, but the market, by the way, is still doing quite